I want to cover a question that's come up a couple times recently in our financial planning practice in this week's episode of the Business Owner's Corner, and that's, do bonds still deserve a place in my retirement portfolio? Do bonds still work in retirement? The context here is that inflation is high right now. Interest rates are going up. To combat that inflation, the Federal Reserve and other central banks around the world are raising interest rates. And because of the way bonds work, when interest rates go up, that forces the value and price of our bonds to go down temporarily. That's not permanent. The reason is that bonds they're termed for a certain specific period of time. You might buy a bond from the US government with a 5-year term. If it's $10,000, that means that you're lending the US government $10,000 for 5 years. Every 6 months, they pay you a little bit of interest. And then when the 5 years are up, you get your money back. So if you buy the 5-year bond, it's paying 3% interest per year. And then a couple weeks later, the market rate of interest goes up because the Federal Reserve raised rates. Maybe it's now 4% instead of 3%. Your bond doesn't look so good in the marketplace. And if you needed to sell it to somebody else before the 5-year term was up, you would probably get less than $10,000. Here's the thing. You don't need to sell your bonds. You can hold them until maturity. And the closer and closer that you get to the 5-year maturity, when you get the $10,000 back, the more the value of the bond will rise closer to the $10,000 that you paid for it. So this is how it works. Bonds will recover as long as, in this case, the US government, the borrower, is able to pay you back. Now, the values are down a little bit because interest rates are up right now. Does that mean that bonds don't work in retirement anymore? No, it means they work just as well as they ever have. The purpose of having bonds in your retirement portfolio is because the bonds are your war chest. If you think of a traditional 60% stock, 40% bond portfolio, the stock portion of the portfolio will be volatile. That risk is what we get in exchange for above average long-term returns, or at least hopefully we get that if we're consistent in employing our investment strategy. But we know that there are going to be bear markets and recessions every now and then, and that's going to drive down the value of our stocks. Well, most recessions take a couple of years to get through. It might take as many as 3 or 4 or 5 years to get over. And the whole reason that we hold bonds in the portfolio is because that's the war chest that we can use to outlast the bear markets with our stocks. You try to buy low and sell high. That's the path to the best returns. That's what we're trying to do in a nutshell. And so when we're in a bear market and stocks are low, that's not when we want to sell the stocks. That's when we want to use the war chest, which is our bonds, because they're a little bit more stable in most environments. And as long as you don't have too much risk and too much length in the maturity of your bond portfolio, that's the time when you want to sell those things to pay your living expenses, so you don't have to sell stocks when they're down. You want to sell stocks when they're up. That's the whole point. So bonds are absolutely, they still work in retirement. They deserve a place in most retirement portfolios. Everybody's a little bit different, but the purpose isn't to drive huge returns. That's why we have stocks. The stocks should be driving the returns. The bonds are your war chest to provide a little bit more stability.